Hello, my name is Ivan, aka Armenia. I'm a professional trader with more than 10 years of experience. I'm a main trader in VTF trading, where we share our trades in crypto, stock, and forex market. You can find link for it below in the description. Today we're going to talk about order block, breaking block, and mitigation block, as it was block of our free course. Before we start, please like this video, hit subscribe button, and set notification on for next videos. Let's start. Today we start with order block and a block in an area where there has been a large concentration of limit orders waiting to be executed. Order block are identified on a chart by observing previous price action and looking for areas where the price experienced significant movement or sudden changes in direction. Criteria: liquidity withdrawal, absorption, and additional criteria: test area of interest, imbalance. So as you can see, we have this sell side liquidity. We take in this liquidity by this bearish candle. Everything is happening in this point of interest, the support zone, like whatever. And next we have this bullish candles that fully absorbing this bearish candle. It can be with full absorption or like partly, like this. And this will be a confirmation. This will be our order block. Order block basically traders who've been trying to short here because they saw this candle like patterns or low time frame, like whatever, they got caught in this area, and short orders, like what is like stop or like executed orders for bears, it's just buys. That's why when price will come back to this order block, all orders of this like bears or like bulls, that depends on type of order block, will be executed. That's why price will go to opposite direction. We have two entries, test of order block and 50% of order block. This is like bullish order block. I like using order block with fair value gap and with liquidity grabs, and also with premium and discount market, because not every order block will play out. Yes, it might give some reaction, it might not. This is a bearish order block. As you can see, this is order block on a daily, and this is fair value gap on weekly. Right now we will see a reaction on 50% and like full just like touch of order block. Like screenshot below, as you can see, we just barely touched order block and got this reaction. Next one, as you can see, we have this order block with 50% test. You should understand that you have to look only on body of the candle, how it closes, because here just shadow of the candle just does damage. It can just have like stop hunt, or like it can just have weak grabbing liquidity, activating some stops that people placed under this low and went up. And as you can see, price went up. Breaker block. Breaker block is an impulse punch to order block after new structural elements formation. It uses as a reversal model and as a continuation of the trend. So here, for example, we have bearish breaker. So after it, price will turn around and will go down to this fair value gap on a daily time frame. No, it's on a weekly. Bull breaker. Before bullish breaker formation, the price removes liquidity from the previous structural elements, from high low to continue the uptrend, and from low low when the structure changes to an uptrend. The beginning of the growth occur after the test of the support zone. The bullish breaker is confirmed and acts as a support zone at the moment of the breakdown of the bearish order block. After the test of the updated maximum breaker block, the price keeps going higher. The break is determined with the shadows of the broken order block. Before the breakdown, price can consolidate, stay in the bearish order block without going beyond its upper border. This will not affect the relevance of the future breaker. Use breaker with bullish imbalance. The price, by analogy with an order block, will seek to fill, partially or completely. Efficient pricing within it before start growing. Stop loss can be placed under the lower breaker border. It's aggressive play. This makes it possible to open position with a high risk reward ratio and under the minimum that updated the liquidity for the sale. This is conservative. This is a safe stop loss. The risk reward ratio will always be less, but you will have high win rate. As you can see, this is a bullish breaker. Price went here, consolidated for a while, and went up further. Same on Google. And if we open Google right now, Google went up further, and it's just barely touched it. Mitigation block. So mitigation block, you using it for uptrend. It will be like a lot of information, but don't worry, I will show everything on live chart, so you can understand how identify it and use it. Many people forget about mitigation block, but it's very useful tool when you trade trend. Especially will be useful when crypto will have bull run. Mitigation block is an impulse broken high or low after the formation of structural lower high or high low. It uses as a reversal model and as a continuation of the trend. The main difference from breaker is the absence of liquidity withdrawal. The mitigation block is formed according to the principle of unsuccessful swing. A bullish mitigation block is defined as the highest rising candle of an impulse high. After an impulse break of the lower high, the mitigation block is confirmed and becomes a support zone. After its test, the growth is expected to continue. Short positions should be taken in the period between A and B. Get the opportunity to fix the loss that occurred on the increase in price between B and C when the price returns to the support zone A. When closing unprofitable short position, traders buy, which leads to higher price. The presence of a bearish order block at point A is not a mandatory criteria for the formation of mitigation block. A bullish mitigation block is identified with the shadow of the highest rising candle that broke previous high with impulse. Before impulse break, the price can consolidate near lower high without going beyond the swing. Extremum, this will not affect the relevance of the future mitigation block. Use mitigation block with a bullish imbalance. The price, by analogy with an order block, will tend to fill partially or completely in efficient pricing within it before growing. Stop loss can be placed under the lower border of the mitigation block. This makes it possible to open position with a high risk reward ratio and under the low from which upward pricing began. This is a safe stop loss risk ratio, and the profit will always be less, but the win rate will be higher. Criteria for the formation of a mitigation block: unsuccessful swing, high low, lower high formation, support resistance zone test, impulse breakdown of the swing from which the correction started, or break up. This depends, or like this is a bearish mitigation, or we have like uptrend or we have downtrend. This is just example. We have like this uptrend, this specific one. This will have, as you can see, mitigation again. So people who've been trying to short there, like we have people who've been trying to short uptrend. They try to play against the trend. They try to open short position but got cut, and they try to minimize their losses. That's why mitigation block plays out. It sounds complicated, but you have to watch on the chart like few thousand times and you will understand how it works. You just understand the gist of mitigation block. It's just basically traders who been trying to open position against the trend. Okay, now let's look at order breaker mitigation blocks on the real time frame. I'm using an indicator it calls super order block. It shows me order blocks, fair value gaps, not all of them, but most of them. Also, it shows break of market structure, but not that accurate that I can see it, but still it helps sometimes. I'm using this indicator just to speed up my analysis process, and you should understand you should use indicators that only help you but don't affect your opinion on the next price movement. So first of all, let's look at order blocks. Order block basically it's traders that been blocked in opposite direction, right? So like let's open monthly on the Nasdaq, and what we can see here, we can see this bullish order block. Why it's bullish? Because people who've been trying to short on this specific candle from May 21st, they've been locked right here. They try to short position, short like Nasdaq, but price went up, and they don't want to close position in a loss. Most of the people they waiting for close position for like minimum loss or like at the break even at least. Some of them they even like want to keep holding the position. I think you okay notice that many people even like move their stop, which is a huge mistake. I will do also a video about like risk management when I will be talking about it, the common mistakes that people do. And as you can see, as soon as price came to this order block, we had huge reaction with bounce, because most of the traders who've been locked in this order block, they close their position, and closing short position, it's like buy, it's a market buy, because most of the traders they set in stop limit as a buy market as a market stop loss, because we have limit orders where your order will be executed with price that you set, or we have like market, basically your order will be executed with like market order, like at any price that the market offers. That's why when you set in stop loss and we have a huge impact on the market and price like move it rapidly, for example this is what happened last week on the euro. As you can see, price like went down, and if you put your stop, for example you open in long position, you put your stop like right here, your position yeah, right here, let's say you put your stop right here under this candle, your position will be just like slammed and you will be closed. Like you're gonna be lucky if you close on this swing. I can bet most of the people got stopped only here, and all your position was slammed basically and closed like too far from your stop loss. Also, this is a fair value gap. Fair value gap, it's like when we have like offer only from one side of the market. So here, for example, we didn't have offer from buyers. We had offer only from sellers, because it was an aggressive movement down, and price always trying to rebalance these gaps. But I'm gonna talk about it in like a next video. Next one, it's breaker block. Breaker block, let me see, it's basically order block that was punched by another candle with fair value gap in it. Let's find this. As you can see, we have this bullish order block. And what happened with this order block? It was slammed with this fair value gap, with this one. So next time price will come to this fair value gap, it also will be breaker block here. So most likely we will get reaction here around like 50% on the equilibrium of it, equilibrium of this breaker block and this fair value gap. You should always like combine this thing as breaker blocks, fair value gaps, order block, mitigation blocks together. So as you can see, we identified this breaker block, and now we will wait for reaction. If we go on the lower time frames, we can identify this candle. This is like order block. It's been tested, but it's not, was just like tested by touch, but still can be useful in our analysis. You can use instruments like rectangle just to mark it on your chart to see it more clearly, because on like different time frames some figures will be looking completely different. And now let's talk about like mitigation block. So mitigation block, it's basically like traders that been trying to play against the trade. The best example I've seen, it's like on pound. We had like trend. We've been going like up and down, right? So traders who've been trying to open long position in downtrend, it's like same as order block. They've been trying to open position in opposite direction. So mitigation blocks is basically traders who've been trying to open position in opposite direction, opposite trending direction. So as you can see here, market will always try to get back, and as soon we came to this zone, we got reaction. Was it here or like here? It happened because people trying to close their position at least at small loss or at break even. Right here, it's like people trying to long, so they had their stop to sell. And this would happen when we came to this mitigation log. We start selling. That's it. That's it, simple. You have to understand what every tool is. Order block, this is like when traders locked inside the opposite direction movement. Breaker block, it's like when price just punish this order block, this traders who've been locked, and basically these traders keeping their short position if it's like a bearish, or like long position if it's bullish, they keep this position. But when price going back to this breaker block, they like panic and start like selling to be at least at break even. This is how it works. Mitigation block is just when people been opening trades in opposite direction when we have trend. That's all. I hope you like this video. don't forget to subscribe, hit the notification button, like this video, and also if you want to join our community, you can find a link below in the description, and also on our main page